wait for the bounce. But then the market turned up. That was the whole problem. The market stayed down. I was in, like Flint. You know what I'm saying? But the market didn't. It didn't trend down.
In like Flynn, he doesn't know what you're talking about.
What?
That's before his time. In like Flynn?
In like Flynn.
Harold Flynn?
Yep.
You are. Hey folks, this is of course Brian Shannon. Brian Shannon is author of the #1 technical analysis book, Technical Analysis Using Multiple Timeframes. Brian Shannon is going to talk to you about technical analysis. There's really no other person you really want to talk to about technical analysis better than Brian Shannon. So please give him your attention and take it away, my friend.
Thanks, Roy. Good afternoon, everyone. Thanks for being here. We're gonna talk about technical analysis, as he said, and what might surprise you maybe is the simplicity of what I'm going to talk about today. Nothing really complicated. No oscillators, no indicators. If you ever looked at what I say on Twitter and that sort of thing, I kind of have known for saying only price pays, and it's because price is the only thing that matters. We have people all the time talking about this market and, well, it's up on light volume, but the volume was light. But it's just like a popular thing to say. It's something that people say to Bob Pisani, hey, if you say but it was light volume, it sounds smart or something like that. Fact is, though, if it's up 2% or if it's down 2%, who cares what the volume is if you participated in the move and you made money? If the volume was light and you lost money, well, it's going to suck just as bad if it was heavy volume. It's not going to, the only thing it's going to do is give you an excuse. Oh, well, there's a heavy volume move, and excuses are just excuses. We're we're talking about making profits. So I've got a lot of slides here, so we're going to go through them at a fairly fast pace. But if you have questions at any time, definitely slow me down. We'll take a look, and we're also going to bounce around on looking at some real charts as well. In particular, after we're done here, we'll do that. So, trend trading, obviously, I mean, people talk about value and growth and that sort of thing, and really, you think about a value stock, it's just a stock that's dead before it becomes a growth stock. We're all interested in growth and making money and trend trading. Stocks follow what's known as the path of least resistance. The big money is made by being involved in the trend. You can scalp back and forth in ranges and that sort of thing. But the question is, what is that longer term trend? Well, the longer term trend is just the sum of a bunch of shorter term trends. So when you think about it, the short term trend leads the longer term trend. What we want to really look at, though, is to get that alignment of trends across multiple time frames, which is what I like to talk about. The only way that we're going to make money is that when we buy, somebody buys after us. Or if we sell short, there's more sellers coming in. So what we want to do is we want to use technical analysis as a roadmap to try and understand the psychology. We want to learn to anticipate what's going to make someone get involved in this stock. Is it that you've got a catalyst? You need a catalyst for movement. And the catalyst might be fundamental or just purely technical. Stocks just break out and then they run. And people say, well, what was the news? What was the news? They try and assign news or a reason to a movement when in fact there's just a big buyer in there. But obviously, as you guys learn here, the fundamental catalyst is basically what Mike's talking about a lot, the morning news and what's in play. So the fundamentals can do it, or the technicals, but we want to anticipate and then be ready for when the time is correct. So we want to say, what's the catalyst? Is it this stock breaking out? Is it a 38.2% retracement? Is it a pullback to a rising moving average? And those are sometimes very good places to buy, or what I like to say is you don't want to just buy a stock as it pulls back to, for instance, the 50-day moving average. You can point to 100 examples where it's worked really well. But you can also point to 100 examples where it didn't work very well, and in particular from a short-term standpoint. If you're talking about a 50-day moving average, it's the average price of the last 50 days. It's not going to move very much. Each day only has a 2% weighting. Whereas if we look at, instead of the daily time frame, and say, well, when we look at that pullback, what's actually happening near that 50-day moving average? Why is that 50-day moving average acting as support or resistance? Why is the 38.2% retracement this focus level? And that sort of thing. So what we want to understand is the psychology of the participants so that we can participate when we have confirmation. And then, of course, the number one job of a trader is always, regardless of what your approach is to manage risk and make sure that you're going to be here the next day to trade again. So again, I'm kind of trying to go fast because I have 100 or so slides here. I was trying to cut some out and I just didn't think of any that could get cut. But if you do have questions, slow me down. I don't want to confuse anyone here either. But again, it's pretty simple stuff. And someone I know said to me once, he said, what people don't understand is that the simplicity of the market is really its greatest disguise. That people are trying to make it so convoluted and that sort of thing. But it really comes down to psychology. What makes people buy or sell? Why is a 50-day moving average important? Who in here looks at a 50-day moving average on their chart? I mean, not everyone's raising their hand, but I think that you're just not raising your hand because you're just sitting there not participating. Because 95% of the people who look at a daily chart will reference a 50-day moving average. That's just how it is. It's just what we're trained to do, basically. It's just kind of accepted that this is an important level. So when you see a stock pull back to that 50-day moving average, a lot of people look at it and say, hey, it's at support, so they stick in their bids. Other people who've been selling on the way down, think about the big institution that has been riding this stock higher. They're pulling back on their position, so they're selling it down to the 50-day moving average. Let's sell 10% of our position, or down to the 50, when it gets to the 50-day moving average, we'll stop selling. So we have less supply from that institution. We also have new demand coming in from people that say, hey, the 50-day moving average is support, so I'm going to stick some bids in there. Well, we find that little equilibrium where we have less supply and more demand, and the stock stops halting, starts finding that little base of support, and when it hits that important level that a lot of people are looking at, that's our cue to take a closer look at the intraday action, to drill down to shorter term time frames and say, have the buyers started to regain control in here, or is it just still showing a pattern of lower highs and lower lows over a time frame of using 10-minute candles over the last 10 days? If it starts to flatten out and turn sideways, then it says, well, that battle is being fought here for control, that the sellers seem to not have as much the momentum anymore. The stock's starting to turn sideways, so now we want to anticipate where will the buyers take control so that we can get involved. So it's really, again, it's about the psychology is really what's most important. And this is, just kind of a real basic chart that, says here are what the average participant goes through when they're involved in a stock. This happens to be actually, this chart was Cisco from 1998 to about 2004, I think. Okay, these are weekly candles, but it really represents that stage, four-stage analysis. But based on what are the average long participants holding, kind of the buy and hold type people. And the point is, you don't want this to be you. You don't want to be going through all these emotions. You want to look at it in terms of the market structure and say, hey, it's in an uptrend. That's great. I should be long here. The sum of the rallies is going to be greater than the sum of the declines. Higher highs and higher lows. There's just mathematically more opportunity to the upside. It makes sense. There's more opportunity to the downside. It doesn't mean you can't make money getting long some bounces in here, but that's not what the odds favor. Some people try to fade the strength. To me, it's kind of foolish. You're betting against the crowd, and the crowd. They say, well, the madness of crowds, or the crowds are always wrong. That's not true. The crowds are right when the market is trending. Now, the longs are wrong over here, but that doesn't mean that the momentum traders basically are wrong. Momentum trading is really what we're all trying to do. Whether you define your momentum on just today's price action, or the momentum of, hey, Apple would have been a great buy to hold, stock to hold for 5 years ago. Whatever your own style is, but everyone in here, I think, is short-term oriented. So what we want to do is we want to understand the cyclical nature of capital through the markets, and that's basic, the 4 stages. Has anyone read Stan Weinstein's book? Okay, one. Get your pencils out. Stan Weinstein wrote a book in 1986 called Secrets for Profiting in Bull and Bear Markets. He's the guy who popularized the 4 stages. Stage 1, accumulation. Stage 2, markup. Stage 3, distribution. And stage 4, decline. So that would be going back. Maybe the back button doesn't work. But anyways, so what we want to do is we want to understand there is a cyclical way that these markets trade. Then we want to find the highest probability trades, looking at that risk reward, and then the hardest part is being disciplined, not letting your emotions get in the way. And here are basically those 4 stages. Now, these 4 stages are going to repeat on every single time frame that you look at. Doesn't matter what the stock is, doesn't matter if it's a currency, doesn't matter if it's soybeans, Cisco, Google, whatever it is. These 4 stages are the stages, similar to the economic life cycle, which is expansion, peak, decline, and trough. Right? That's the 4 stages of the economy. Well, for stocks, it's stage 1, accumulation, which precedes a move higher into stage 2, followed by distribution, and then a decline, accumulation, and then back to markup. Now, it's not always going to be nice and perfect and simple like this. But what we want to really focus on is we really want to avoid these periods, the stage 1s and the stage 3. And the best way to recognize that is when we have these moving averages crossing back and forth. Okay? A moving average is a simple tool that allows us to say, it smooths out the trend, basically, is what it does. So when we have all the moving averages rising, we want to look at it basically as innocent till proven guilty. When they're all declining, it's basically guilty till proven innocent. It remains in a downtrend. Okay? These rallies will most likely fail. When we see the moving averages crossing, okay, and here's the thing, you hear about the death cross and all that. It's just the stupidest thing ever. Okay, we had a death cross in the S&P 500 about 2 weeks ago, and then the market rallied 9%. About a week and a half ago, we had the death cross in the NASDAQ, and then the NASDAQ was up 4.5%, 5% in 3 or 4 days. Doesn't mean it doesn't mean there, it doesn't mean there might be trouble ahead. We get the so-called death cross, but then the market bounces. But once we break the low of that stage 3, and we have a pattern of lower highs and lower lows, and all the moving averages are heading lower, then we want to be aware that guilty till proven innocent. These sideways activity, though, are basically, they're a waste of time. If you're going to be trading a stock that's going sideways, well, you either want to drill it down to much shorter term time frames. So if this was constructed, which it is, of weekly candles here, you see the months down below. So this is the weekly time frame. If we wanted to trade this stock in here, well, we could take a look at this and kind of open that up and say, well, here, on a daily time frame, we've got a stage 2 uptrend, stage 3 distribution, stage 4 decline, stage 1 accumulation, stage 2 markup, distribution, and decline. So in other words, you can drill down to a shorter term time frame and make more sense of this mess, or you can just avoid it and find something else to trade, which is generally what I think is the right thing to do. So when it comes to market structure, this, the main thing we want to look at is price. Only price pays. Okay? Anyone have an idea what this chart is?
What's the S&P?
Price over there is 66.
Oh, no. It is what the S&Ps look like over the last 30 days.
Is it the Russell?
Mm-hmm. It's a Russell, yeah. That was the Russell through, I think, I don't know, maybe Tuesday of this past week. Anyway, so that's the IWM. And it does obviously look like the S&P as well because they're highly correlated. Volume, okay, added below, and then time. To me, this is really where we have our edge. You guys aren't going to be looking at this. I mean, you look at that daily time frame, and you look at it and say, well, you know what, it's in a downtrend. Well, we did just show here, however, though, we had a higher low, and then we created a higher high right here at this point. Okay, so what we want to do is we want to drill down on this action. So what we do is we take a look at that and say, well, on the 30-minute candles, so each day the market's open from 9:30 till 4 p.m., right? 6.5 hours. So one of these daily candles is going to be how many of these 30-minute candles? There's 13, yeah.
13.
Yeah. So we're basically taking this and putting it under a microscope and viewing it at 13 times power so we can get a little bit finer detail and say where, what's going on in here. Stage 4 downtrend, stage 1, 2, 3, 4, 1. Here's a stage 2. Then we break that down further to these, 5 days, and you can see even more detail into this action. So we're just trying to say, break it down further and further. So if these are 30-minute charts and these are 10-minute charts, we have 3 times as many candles here. So there'd be 39 of these equal to 1 day. And that's where we're getting this granularity, where we can see this little basing pattern at the end of the day on, I guess that was Monday maybe. Okay? And then as it breaks that on Tuesday, well, where are we overall? Well, this is that consolidation right here near that 65 level. And it's right also at this prior resistance level. We break out and then it runs real quick. What is that over here? It really doesn't look significant. That 65 number, it really doesn't have much significance other than, I guess, these highs right here. And where then would you expect the next potential level of resistance? Where would you expect the next likely area that sellers might be found?
67.
Yeah, about 67, 67 right up to the top of that yellow right there. And this is kind of just a little outlier where it gapped up that day. And from that failed move, that failed breakout, came this fast move lower. But this is where you would expect there to be a likely source of supply that's going to halt or at least slow down this upward momentum. It's not necessarily that there's resistance at 67. People will look at a chart and say, here we are at 66. They'll say, hey, resistance is at 67. And how do they know that? The fact is they don't know it. That's potential resistance. There's a big difference. Because people who would say that this is support, right over here, they would have been maybe buying on that day. That was potential support. It blasted right through it, obviously. So the point is we don't know until after all analysis, fundamental and technical, is basically hindsight. Okay? How much, a PE is hindsight. You could go dig around at the company and say how many things are going out. That's a little bit different and try and anticipate. That's anticipatory fundamental analysis. What we're trying to do is say, where do the buyers or sellers take control? How do we break this down to real nice movement and look at it and say, make some sense of this when we have these beautiful uptrends and then the distribution, and then right over here, we're breaking this important support. We're below all those moving averages. All those moving averages are declining. We broke down on real heavy volume. Relative to that, the volume on this recovery up towards this prior support was lighter. So those are all pieces of the puzzle that are lending us insight into the psychology of the market. Okay? The thing with technical analysis is that most people try to take it too literally. Okay? They remember all the different little candlestick formations, individuals, and 3 dark clouds and 3 bearish soldiers and all the nice little names they have for them. But really there's in my opinion, 0 value to understanding all of those and memorizing all the things that are in those candlestick books. So we've all seen this and we know the answer is what? They're equal, right? To a kid who sees it for the first time, he's going to say, well, that one looks longer, or whatever. You could make a case either way. It depends on what you're looking at. So pattern recognition is good to know. Here we have a bullish inverse head and shoulders pattern. But, take the same exact information, and people were calling this a head and shoulders top. And you put them side by side, this is the same exact market. And this is the S&P 500 about 2 weeks ago. Okay? Same exact market. So which is it? Is it bullish or is it bearish? Point is, when you just train yourself to look at patterns and not try to understand the psychology and the implication of what this move or that move might be, you're just going to get confused. You say, well, it was a perfect cup and handle though. Why didn't it work? Because you're just training, you're like a monkey recognizing patterns. Anyone can recognize the patterns. It doesn't mean there's not value in them, but what's more important is if we just take kind of all that crap off there and look at it and say, here we had a big level, technical level broken at 105, 104 and a half, 105. The market had a quick shakeout and it failed to really break lower. The people who were selling down here at 102, 103, why didn't they think to sell up at 120? The people who were selling short in here, were saying, hey, there's momentum, it's going down, let's lean into our shorts here. Fine, that's good. But from that failed move here came this fast move higher. Why do we get a fast move out of there?
Covering.
What's that?
Covering.
Covering and people, and so if you were long over in here and then you finally decide after it drops from 113 to 102, you finally say, okay, now I'm going to get rid of my longs. It broke that low, and the guy on CNBC said that was important. You know, wait a minute, it was just down 10% in 10 days, and now you're selling? I mean, it just doesn't make much sense. So for the people that sell down here, then they see it run up like that. They're thinking, oh man, here we go. I got to buy my stock back. So we've already gotten the supply out of the market. Now we have, you know, basically triple demand after this because you have the short covering, right? The people who are trapped short, you know, this day sucks for them. Okay, obviously they're losing a lot of money, so they're going to be a buyer. Okay, who's going to sell into this?
Guys who got long.
Guys who got long here, but is there going to be real big supply available? I mean, anyone who really wanted, any big institution that wanted to sell, they've been doing it for 2 months. Okay, so, you know, there's just going to be a lack of supply as well. Okay, so sometimes, especially in bear markets, you do get some of the sharpest rallies in a bear market. You see bigger, faster moves higher typically in a bear market than you do a bull market. The thing is they don't stick. You have to trade them. But there's some fantastic opportunities. The point is the people who wanted to sell have pretty much already sold. Okay? No one's going to really want to short into this. If they do, they're going to get trampled real quickly, and they're going to be back, buying their short position. And they might even decide, hey, now I'm going to get long. Looks like the trend is moving. So we have people on the sidelines who are saying, hey, that looks like the shakeout, let me get involved. We have the shorts saying, let me get involved. And we have an absence of supply. So where does this stock run, this market, the S&P, runs right up to its 50-day moving average and this little downtrend line. And then it halts there and backs off. Now, you could say, well, see, all you have to do is sell short at the declining 50-day moving average. But it doesn't always work that way. Here we stayed there for 3 days and then backed off. And then we pulled back, and now where we are, we have a higher low here at about 105.80. If that 105.80-ish area breaks down, though, I think then we're going to see the next big leg lower. I think it's that important. Because right now it's just a higher low. We're back up to this 110 level, 111, and we need to really clear this 113, because on a weekly time frame we still have lower highs and lower lows. But the point here is, not the fact, but the point here is that, technical analysis is a tool to help us, okay? It's not, you shouldn't look at it as a system. It's a tool to say, where are my odds? What is the, where do I have a good risk reward? How do I implement that trade? And then always, it comes down to manage risk. So what we're trying to do is just understand the cyclical flow of money through the, by looking at the charts. And we need to be objective about it. And if you have a market where you say, I don't know, I can't tell if that's a head and shoulders or an inverse head and shoulders, if you're that confused about it, either switch to a shorter time frame where you can make more sense of it, or just say, you know what, I don't get that market. I'm not going to trade that market. Or I'm going to trade a different stock. There's all kinds of stocks setting up long and short in this market. But it forms a picture of supply and demand, and that gives us the basis for a risk-reward ratio so that we can plan the trade and say, does this make sense? Does it make sense to go in here, and how much risk am I taking relative to how much perceived reward if I'm correct. What's that risk reward? And it's, there's no certainties in the market. People who say, no, technical analysis doesn't work. So, no, you fail to understand how to make it work for you. It would be foolish for me to say, hey, just because I look at technical analysis, that there's no value in a PE ratio. Some people find a lot of value in it. For me, it's not. It's got nothing to do with what I'm interested in the market. I'm not looking for a value relative to their sales or their earnings or whatever. I'm looking for movement, and that's what you guys are looking for. But a lot of people use a PE ratio or cash flow or whatever and make big decisions based on that. But if we can read their actions on the chart, we don't really need to know what they're looking at or why they're looking at it, but how it's affecting whether it's helping the tide go in or out. But the 4 foundations of technical analysis: 1, market action discounts everything. Prices move in trends. History repeats itself. And the 4th isn't really a rule of technical analysis, just general sense. Have stops or an idea of where you're going to cut your loss if the market doesn't agree with your analysis on every trade. But as far as the first one goes, market action discounts everything. It just means that everything known to all participants, it's reflected in the price of the stock. Whether a big options trade took place, the options market makers go hedge that by buying or selling short stock. Whether there's inside information that somebody has, well, they have inside information, but they still have to buy the chart to act upon it, and it's going to get reflected in the price of the stock. The market what is a stock worth? Well, what's the bid? That's what it's worth. As far as these projected PEs and it's at a discount to fair value. No, it's not. Fair value is right here. If you want your money today, that's fair value. There's no such thing as, it's just perception of fair value. If you have your house on the market and you're not getting any bids at $300,000, you say, well, this market isn't recognizing my value, but all your neighbors' houses are selling for $240. You might say, well, they're selling them at a discount. They're not selling them at a discount. They're selling them at fair value. That's what the market does. It's the auction market that says, okay, you want a price right here, right now, here's what it's worth. Anything else beyond that is speculation. You're trying to figure out what it's going to be worth at some point in the future. Whether it's fundamental analysis you do that with, whether you have inside information, whatever that is, it's all reflected into the current price of the stock. So if we can accurately look at that and say who's in control, the buyers or sellers, where does it come from? Where does it have the potential to go? Okay, those 2 questions allow us to come up with our risk reward. Where does it come from? In other words, we just had the market make a higher low on the daily time frame on the SPY at 105.80. Where is it likely to go before, or where's the next level that it can go before it's likely to encounter supply? Well, maybe that 113 level. That's the lower high that we now see on the weekly time frame. Okay, so if it's at 112, do we have a good risk reward if we're going to use a stop at 105.80 and our target is 113? Of course not. That's stupid. So you don't take that trade, but it doesn't mean you can't trade the SPY. You can take a shorter term look at it on a 1-minute chart and say, where are we going, and that sort of thing. So the prices move in trends, and if they're not trending, then they're pretty much a waste of time, okay? Unless you're anticipating something that you can see that has historically led to, a breakout. So you see that the stock keeps coming up and hitting on this resistance level. It keeps coming up there. First, let's say we have a stock that, here we've got, let's just call this our resistance, what's been resistance. We have a stock that hits right on the A, okay, and we'll call that $20 a share. Well, then it pulls back to this S, which we'll call 15. And then over here, it touches that $20 again. And then it pulls back, but this time it only pulls back to 18. Then it hits here at 20 again. Then it pulls back to 19, and then it hits again. Well, what is that telling us? It's telling us a couple things. It tells us that the time between these tests is getting shorter. Okay? So it might have been 6 weeks, 4 weeks, and then we're back up at that $20 level again 2 weeks later. So in terms of time, it's taking less time for the market to come back and say, that's a price. That's a price where this auction is finding buyers and sellers to match up. We also see that $15, $17, $18, $19 a share, that the buyers are getting more aggressive, not only in terms of time that it takes to get back to that level where this battle is being fought for control, but price rise as well. At first, it ran up to 20, and people were like, well, I'll let it pull back before I buy some. I think $15 is a good value. I'm going to stick in a giant bid there. Well, buy all you can at 15 bucks a share, is what the Fidelity guy says to the Goldman guy. So he starts buying it, at 15 in his account and 15.10 for them. The point is, though, that's where the bid, that's where the bid is. That's where the fair value is. An object in motion is going to continue in that direction until it's met with an equal or greater opposite force. So it's going to drop down as long as there's more supply. It's going to than demand. It's going to drop down to a point where somebody says there's enough demand here now that we're not letting this stock drop any lower. And once people start realizing that there's a big buyer at 15, they start going, well, there's a big buyer at 15. Well, I'm going to bid 15.01. And someone's going to say, well, I'm going to bid 15.05. And then you're going to see that the bids are starting to creep up. There's a little bit more conviction in terms of the size of the bid, although you probably won't see it because people are just lying in the level 2. But you'll also see that people are starting to take the offer at 15 and a dime, 15.12, and that sort of thing. It's moving quicker. So now the market came down. We reached that little equilibrium where the buyers could buy all they could down there, and then the sellers were removed from the market, and the sellers are basically out, for the most part. They're saying, well, I'd sell it at 16 though if it can get there. And the buyers are saying, well, let's buy it. It looks like it's going to go run up for a test of 20. It runs up to 20, then it pulls back instead of 15 to 16. So that process is repeated over and over again. But what it's forming is a picture of these higher lows that might be an inverted head and shoulders pattern, or it might be a cup and handle, or it might be an ascending triangle, or it might be some uncategorized pattern that you can put your name on. The fact is, though, what we want to recognize is not the patterns so much and the three little dojis that are and that sort of thing, but what is the real message of the market? The real message is the buyers are getting more aggressive price-wise and time-wise, and that makes it more likely that this stock, if we can rid the sellers at that $20 level, we've got this market now with these higher lows in firmer hands. The buyers are really gaining control of this stock, and if it breaks that $20 level, then it's likely that it can continue to move higher. And the basis of understanding that is that humans act in certain ways. When a stock breaks out, we get alarms going off, we got bells and whistles, we got people yelling across the trading room floor, we've got chat boards that line up, and they're all saying, hey, do you see this stock breaking out? And it's just a self-perpetuating at that point when it breaks out. But as George Santayana says, those who can't remember the past are condemned to repeat it. Okay, that's the negative take on it. Those who can't remember the past aren't going to see the opportunities in front of them unfolding either. Say, wait, I saw this last time. That's why these guys are teaching you 8 different patterns and that sort of thing. Or 8 different patterns, and saying, here's a couple patterns that have high probabilities. They're not guaranteed winners. There's no such thing as any pattern that does that. But these are high probability type trades where you're likely to find opportunity, and here's the money management techniques to go along with it. But you have to be prepared for anything. And when I talk about stops, I always mention stops because you got to have a stop, but you don't. I rarely set a stop and say, okay, I bought it at 20. I'm setting my stop at $19.60. I'm going to go, if I'm going to take the afternoon off, I might do that. More likely, I'd probably just be checking my phone all day and then calling in the order. But I might put a stop. I rarely put a stop in. Instead, what it means is just be aware of the level where you're going to say enough's enough. Right? Otherwise, losses can spiral out of control. But these 4 stages, what we want to do is we want to focus on 2 of them. This is where our opportunity is, in the uptrends and the downtrends. And if they're going sideways, they're pretty much a waste of time. Again, Doesn't mean you can't drill down to a shorter term time frame and find that same stage 4 right in here, stage 2, 3, 4, 1, 2, over and over again. But what we want to do is we want to buy them after they pull back and when they break out. Now this is something I think I put together in January, I didn't update it. But anyways, we still see, on a monthly time frame, that's the spiders. Here on a weekly time frame, there's a daily time frame. We can see these, that this cyclical nature occurs. And this was, for some reason I did update this one, but this is the SPY as of Tuesday. So, you look at these 4 stages and say, where are we? Where are we overall? Well, when we're rising in here, generally on this 30-minute, 65-minute time frame, that we're going to be looking at it is we've got these higher highs and higher lows. And I've got what is a 5-day moving average on here. Okay, so if we're looking at why a 65-minute time frame instead of 60, does anyone know?
Sure. So you divide the day into 6 periods for hourly charts. So you have 6 bars and you have the cracks.
Right, exactly. Because otherwise we've got, if we use hourly bars, the market's 9:30 to 10. We have 1 half-hour bar, and then in 10 to 11 is we have 6 1-hour bars and 1 half-hour bar. So we want to make them all equal, or use 30 minutes, but 60-minute charts. So this orange line, this is something I talk a lot about, just for general market direction and for stock direction. The orange line is what's equivalent to a 5-day moving average. Okay. To me, this is really one of my main guideposts for kind of like the intermediate term trend. So what period would that be? How many periods, how many 65-minute periods would that 5-day moving average be? Right?
25?
Close. Where we have 6 individual equal periods over the course of 1 day, right? So over 5 days, 30. So that would be a 30-period moving average. I also use this a lot on a 30-minute time frame. Okay? So on a 30-minute time frame, what period moving average would that 5-day moving average be? So there's 13 30-minute periods of time times 5. We've got 65 30-minute periods. Okay? If we're looking at a 10-minute time frame, well, here I think I have it. So a 10-minute time frame, here's that same 5-day moving average. See, you can look where the market crosses right there that day. That's right here. Okay, so we're just getting more granularity. So here's our 65. So there's the 10-minute time frame. So it's in the same place. Okay, so this would be 195 10-minute periods. That's how long the market's open, 9:30 to 4. So that's what we want to focus on. On a daily time frame, and something I think that you guys probably, most people in here, day trading basis, to me, the volume weighted average price is probably one of the most valuable tools you can look at to say who has control for the day. And we'll talk more about that, but we want to use it like a moving average just to say, what's the direction of it? If we're below a declining volume weighted average price, it means the average price that the market is finding value at today is declining. Okay? If it starts to turn sideways, saying, well, the buyers and sellers are really kind of duking it out here. And then as it makes a higher high and then a higher low in here, the buyers have regained control for this session. This is just this session only. Now I use it on a 1-minute chart primarily, but I will also consider things like, since a breakout that occurred 3 days ago, what's the average price? So who's in control since earnings were released, or that sort of thing. And when it gets really far extended away from those moving averages, well, you want to be selling into some of this strength. Or raising your stops up underneath the higher low and recognize the lower high that, hey, we probably got some distribution going on here, and now we've got these lower highs and lower lows, and we're in a stage 4 decline. The volume weighted average price isn't your perfect tool. There's no such thing as your perfect tool. It's using a lot of things all at once. If I had pivot levels on here, and if I had this might have been daily R2. A lot of times you'll see that. It'll hit it to the penny and then back off. This might have been the pivot, or S1. But the point is, we want to use all these tools together and say, where's my edge? When I have a market that's just going sideways like this, I look at this chart and waste of time, on to the next one. There's nothing happening here. It doesn't look ready to break out. It doesn't look ready to break down. It looks like it's smack in the middle of this range, and I'm not a range-bound trader because I like the action, and this bores me to death. So you either switch to a shorter term time frame and say, hey, well, there was a stage 3 distribution, stage 4 decline, there's some accumulation. You can trade it. It's just what's your personality. But understanding market structure allows you to say, well, these are the types of stocks that I do want to trade. So the way that stocks move, the way that markets move, is they kind of move all at once. They move real quick, and then they pause. They say, hey, wait a minute. This thing got ahead of itself, you hear that, or it's overbought, it's oversold. Those are all just subjective ways of saying, hey, it's up a lot recently, or it's down a lot recently. It just had this big move. Where does it have the potential to go? Where is it pausing? Is it pausing at a prior level of support that's now becoming resistance? Well, what we want to do is we want to say, how is it acting after that big move? Does it hold on to those gains? It's either going to correct through time, or it just turns sideways, or it's going to pull back and make lower highs and lower lows, but the primary trend is still up. So we have a short-term downtrend within a primary uptrend. Those are good opportunities to recognize for the next move, to set up for the next move. So which do you think would be considered more bullish? A time correction or a price correction?
Time correction.
Okay, because why?
Because the price isn't coming down.
Yeah, the price isn't coming down, so what does that tell you?
It's stronger.
It's stronger because what?
Because the fair value of the stock is higher.
The perceived fair value, right? So because there's still buyers here. The buyers are saying, you know what? Give it to me at 26. I'm not asking for 25 or 24. Over here they said, nah, I don't want it at 32. I'll take some at 30. I'll take some at 29 and a half. So they're not as aggressive. It's showing that there's a stable source of demand under there, and that the sellers might be coming in, and we're not even talking about volume right now, because the volume's actually pretty heavy in there. Okay, it's kind of churning. Over here we have a low volume pullback, which is considered bullish. Why is a low volume pullback considered bullish in an uptrend versus a high volume pullback?
No conviction.
It's what?
No conviction.
Well, the sellers don't have the conviction. It's just kind of a buyer strike. The buyers are just kind of pulling back or go, okay, let's see what you got. You come to me. Let's come, give it to me here. And but in this case, they're saying, no, I want it right here. I'm holding my ground. So it's generally more bullish. You're going to get a more powerful move out of there. So yeah, and in a downtrend, the same thing. Okay, this is, the market's either going to correct price-wise by bouncing within the downtrend, or it's going to turn sideways. And if it's turning sideways, the sellers are like, the buyers are saying, I fell for that last time. I'm not going to buy this thing. We'll buy a little in here, but I'm not going to chase it. Because once that trend is established, it's more likely to continue in the direction of that primary trend than it is to reverse. That's just the way it goes. An object in motion. So support and resistance are the building blocks of trends. Okay? Stock goes and makes higher highs and higher lows. It pauses either time-wise or it pulls back price-wise. So where we find resistance, what is resistance? It just stops going higher because there's more supply up here than what the buyers are willing to take right now. So the sellers say, well, let's start pushing our offer a little bit lower because we want to get out of this, and let's start hitting some bids. And then it comes down to a place where there's enough demand, there's enough buyers in there saying, we'll take it. Higher highs and higher lows. That's really, that's all you need almost. It really is. I think that if you had just different time frames, that's really, I didn't know it did that. Okay, that was a waste of time. Anyways, so, some general concepts of support and resistance, okay? Everyone's heard this, right? Resistance broken becomes support. Well, it tends to act as support. It doesn't always, because we see failed breakouts. We see the stock break resistance, everyone gets excited, it breaks down, you better get out quick because there's, from those failed moves often come these fast moves. But why does resistance tend to act as support? What's the psychology? How would you feel if you were short in here and then it breaks out? How would you feel if you were long? How would you feel if you were in cash? All right? Ask yourself those questions. How would I feel? And you only know by having been there before. How would you feel right here if you were short in the range? It would suck. You're like, oh shit, what's wrong with these people? Why are they buying this? Don't they realize the fundamentals suck? No, that's not the right way to look at it. That's your opinion. The market's telling you a different opinion. The market's saying, we're ready to go higher. Forget the fundamentals. We're looking forward. We're thinking about where this company or this economy is going to be in 6 months. So the shorts, see this thing pull back, and they might try to press it back in. They might try to lean on it, but they can't get it back in there, and it starts to rise. They're thinking, I got to get involved. Or the people, the institutions who have been accumulating this for 6 months, and they've been trying to buy 5 million shares, and they buy up 4.6 million shares, and they're right here. Well, then they get on the phone and they say, you know what? Here's what I want you to do. Finish that order today. Get it done before the close. Don't be shy about how you do it. Go in like the Bank of Japan, buying up the yen. Just get it done. Why do they want to be sloppy about it, in other words? Why would an institution do that? Yeah.
Encourage other buyers to hop on?
Yeah, because they've got 95% of their order filled already. They've got a meaningful position. Now they're saying, let's goose this thing a little bit. Let's advertise it to all those dopes that look at charts and have their little beeps go off and get all those guys on the SMB floor to yell, hey, this one's breaking out. And all these momentum guys will jump on it. And it'll drive, and Maria Bartiromo will say, wow, XYZ was up 10% today, and we heard there's some bullish activity, whatever she says, I don't even know. But, and maybe she doesn't even say that. But the fact is, it's a way of advertising as well. That institution is saying, hey, we got a ton of this stock. Let's get other people. We've quietly accumulated. Let's let everyone else know. Let's, kind of paint the tape, which they say is illegal. But, the market is constantly, what was that?
So we can sell it back to them at a higher price.
Well, exactly. So if you have this stock, and it breaks out, so they break it out, and then they get everyone else to kind of jump on board, and it rallies, and then it begins to pull back. So maybe they bought 400,000 shares here, and now they get their full 5 million shares. Okay? Now, if you were George Soros or Paul Tudor Jones, you might be thinking, well, you know what? It breaks out at 20. It ran to 22. Let's start feeding a little bit out between 22 and 25. Let's see what we can get rid of. Because these people are chasing this. It's still a little bit early in this game. So they maybe sell 100,000 shares into this strength. Okay? Then the stock starts pulling back. They still like the stock. Maybe they sold 200,000 shares. Okay? They traded 5 million shares on that breakout day versus an average daily volume of 1 million. So they sell 200,000-300,000 shares. So then it starts pulling back 1 day, 2 days, and they say, hey, wow, it's right at that 5-day moving average. Let's start bidding for some in here. That way we'll start to show people that there is demand in here, that there's still solid buyers. So they have 4.7 million shares. Maybe they're going to bid for 100,000 shares in there, and that might be enough to show that, hey, there's something good going on here. It pulled back for 2 days. They weren't selling aggressively. They were selling into the strength. They were selling when they could, not when they had to, trying to chase it lower. So now they can kind of put a little bit of 100,000 in there. Other people will say, hey, it's at its 5-day moving average. That clown from Alpha Trend's talking about it now. This guy's talking about it. These guys are buying it. Whatever. There's, so more people start bidding in there, and then it starts moving higher again, and they say, just hit the gas again. Just go market on open 50,000 shares to get it to gap up a little bit. And then they sell a little bit more, and then they're, by the time it's gone through its full up cycle, they might have 1 million shares left when it's $50 a share. And then it starts going sideways. They're selling some in there, and then a piece of bad news comes out, and they say, you know what? Just hit it all out right now on the open. Anyway, that's the way a successful, you know, and no money manager obviously does it right all the time, but that's the way you would want to do it, and that's the way it is done sometimes, and it helps create that picture of higher highs and higher lows, or lower highs and lower lows. How do all the longs feel right here?
Not good.
Not good. I read something the other day that there's a 1 to 2, I don't know if this is true, I don't know how they measured it, that there's a 1 to 2 basically feeling of emotion in I'm sorry, in being right, in making money versus losing money, meaning that they say somehow, I don't know how they quantified it, and it was Hayes Advisory, I think, someone had forwarded this, that the emotion associated with losing is twice, you know, it sucks twice as bad basically as it feels good making money. So, you know, it feels good to make money. Yeah, I made money today. Fuck, I lost money today. Man, I got my ass kicked. You know, but you know, losing is elicits a much greater emotional response. Okay, so in a downtrend, the fear really gets people to do dumb stuff, and you get these really sharp sell-offs. But how would you feel if you were long? You know, you'd be hating it in here. Oh, if it just gets back to my break-even price. I bought it at that support, you know, if it just comes back to even, I'm out. You know, it's like waking up with a hangover. Never again. That's it. I'm not drinking. I'm done. And we know how that works. I can tell.
You feel this morning.
So how would you feel if you were short, though? You'd be thinking, all right, cool, cover a little bit down there on that panic. When it gets back up to there, let's scare the shit out of these guys. Let's go in there, and we'll put out an offer for 200,000 shares. And you're sitting there long, looking at your level 2, and you're like, is that right? Hey, is that an offer on there? Is that offer real? It looks real. Yeah, they're starting to eat through it, but they're coming back with more. They're refreshing it. So yeah, screw it, I'll just hit the bid then. So they're doing that to scare people intentionally. They're saying, you know what? You want to buy it? You want to see it go through there? You better come here with your big account, one with a high you know, credit limit. So they're trying to scare people out so that they can just kind of drive the stock lower and create that fear from the herd. So support broken tends to act as resistance, and you get this, you know, stair-step pattern up and the stair-step pattern down. Okay, that's the where you hear that. Okay, so when it's in a range, you know, when the market rallies and then it turns sideways for a while, it's more likely that it's going to continue in the direction of the primary trend, that is the trend on the bigger time frame, than it is going to reverse. Continuations are more likely in a trending environment than a reversal. The more times that you test that level of support or resistance is tested, the more likely it is that it's going to fail, and the more times it's tested, the more likely it is you're going to see a bigger break.
Is that true for all time frames?
It is for all time frames, but within the context of the bigger picture, because if this is a 1-minute chart, you know, you'll get a big break like that, but where is it in the bigger picture? You know, where is that forest view? You have to be aware of that as well. We'll talk more about that when we kind of get to you know, using different time frames. But it's definitely true that, you know, you see the S&P 500 hitting, you know, support at 110, 6 times, and then all of a sudden it breaks. And when it breaks, after it's tested a bunch of times, it kind of cascades through that level, because there's more value assigned, there's more emotion assigned to that level than if it had just kind of hit once. So price has memory because people have memory and people have emotions, and that's what gets them to act all at once, basically. So again, even when you see a market that's supposedly, oh, it's down too much, and then it starts to turn sideways, it's more likely to continue lower than that would be, you know, going back to this slide. But it's more likely that it's either at this point it looks like accumulation. Okay, why? Because the moving averages are crossing back and forth, and it was just in a downtrend. So it looks like accumulation, which tells me it's a waste of time. Okay, but it's more likely to break down than it is to break out. It's more likely to just kind of go sideways for a while until the energy is built up enough. But in this case, it breaks down. So this should be pretty obvious, but what is the trend? It allows us to get that momentum. We want to ask ourselves, I think this is a slide on there and I've already said it, but where has it come from? Meaning, where is the support? Did it just break out? How far extended is it? How far close to what would be a reasonable price target? And where does it have the potential to go? Where does it come from? Where does it have the potential to go? That's the basis of risk reward. And risk reward is theoretical. Okay? What if you had your especially on a swing trade, but you take an example like Genzyme last week. Genzyme intraday had news of a rumored takeover, and you might have said, well, that takeover doesn't look to be right to me, so I'm going to short it. I don't believe it. It seems like a rumor, and it's up $5, so I'm going to short this stock right here, and my stop will be $1. Well, then they halt the stock and it gaps up $5. Now what's your risk reward? Okay? You thought you knew what it was, but stocks don't do what we expect them to. It's all theoretical. It's garbage in, garbage out. It's that's your perceived target. Now, if you use things like support and resistance, it's going to help you figure those levels so that you can, those obviously Genzyme or a takeover or an FDA panel on Vivus, the stock gets crushed on that. First of all, you have to understand that catalyst is coming, and that's the potential for the stock. But how do you handle the risk? So we know what trends are, so we don't really need to go through these. But as they say, a trend once established is more likely to continue than it is to reverse. Here's a stock that broke out at $10 a share, and this is that same exact stock. Okay, showing it, I don't know, looks like about maybe 6 months later. It goes from 10 to $50 a share. And all the way up here, there were people trying to say, oh, that's the top. Look at that sharp sell-off. That's the top. That's the top. And you see these people continually just get crushed. You're better off saying, hey, it's in an uptrend. Let's look for low-volume pullbacks. Let's look for areas of support. Let's look for consolidations, and then look to get involved with the primary trend. In a downtrend, the stock breaks support at $42 a share, and then there's people over here saying, hey, it's down too much. Oh, it's a good company. It's a good value. It's all this other nonsense. What's the trend? What's the price? Because news and surprises tend to follow the direction of the trend. Why? Because people anticipate that. Why does Fidelity buy a stock today? Because they think they had a good last 12 months? Or because they look at it and they say, hey, this company's up and coming. They're selling stuff, like Mike was talking this morning about the earnings momentum, not just for one quarter, but if they have this year-over-year growth and we're raising our estimates and our factories can't keep up with the orders and that sort of thing, what's more likely? Is that a company that's going to miss earnings? Maybe if they get too aggressive about estimating what their profits will be, and we expected the factory to be open in July, but here it is, or May, and here it is July, August, and the factory's not open yet, then they're going to, people are going to say, well, why isn't this company managing the construction of their plant properly? What else are they doing wrong? So that stock might get punished, but we want to know, what is that primary trend? And you start with the bigger picture first to just get that bigger idea of where we are. Like I said, I think I've got 103 slides, so it looks like we're halfway through. And I don't know, what time was this segment ending, do you know?
No idea. Can't remember.
I bet you I got at least 45 minutes. Do we want to take a break? Or keep going? It's up to you guys.
Why don't you crack the door?
That's a good idea. It is hot in here.
82.
That'd be good.
Yeah, no wonder.
You gotta be losing weight.
Yeah, doing the sauna.
Dehydrating.
Want some water?
Yeah, thanks. Thank you. Okay, so volume. Yeah, go ahead.
Quick question. Back on the slide you just showed us, the one from $10 to $50. And, obviously, the idea is once a trend's established, it'll keep going. Where do you exit where do you exit that trade?
Well, for me, it would be, well, in here, here we had signs of potential distribution. Okay, we had indecision. So this stock might have rolled over there. Instead it says, hey, we had this nice rally, we've got these moving averages, thanks. We've got these moving averages crossing, we're showing some indecision here. But the 50-day moving average is still advancing, so we're generally going to give it the benefit of the doubt. But once we start distributing and then breaking key levels of support, and we have that bigger moving average, dropping, actually turning lower, then you look at it and go, well, now, looks like the easy money's been made. Even in here, I would say at this point, it's not worth looking at until right over here when it just starts to look like it's breaking out again. And we're going to talk about some stocks that look exactly like that, right? As of Friday's close. So, you look at it and say, well, it's just turning sideways. This is a correction through time more than by price. So that trend is still, the consolidation within that trend is still more likely to go, and the subsequent move is more likely to go in the direction of that primary trend.
You referenced the 50-day trend as not being broken. Is that a 50-day average? Is that an average that you normally look at when you think about selling?
On a daily, no, because my trades are short term, so I don't look at it. I look at it as, here's a key reference point that a lot of other people are looking at. And why does it tend to act as support? Because the people who bought a bunch and they say, all right, let's sell some at 28, sell it down to the 50-day moving average. Again, it's back to the psychology. And other people say, hey, I missed that stock, but here it is, pulling back to the 50-day moving average. I want to get involved. So it's a reference point. I never use moving averages as a reason to buy or sell. Only price would tell me when to buy or sell. It's just a reference point. And why the 50-day moving average? Because that's what most people look at. And what do most people look at? People say, well, is that simple or is that exponential? That's a question I get all the time. Okay, who uses moving averages in here? All right. Now, do you use simple moving average or exponential? So put your hand up if it's simple. I do. Okay. Put your hand up if you use exponential. Okay, that was actually about half and half. But I do that, and maybe because you guys are prop traders, or But if I go to like a trading expo and there's 100 people in the room, I'll ask that. 80% probably will raise their hand and say they use simple moving averages instead of exponential. People say, well, the exponential is faster. Say, so what? Use a 48-day moving average then. That's faster than a 50. The point is, it's completely irrelevant. All it is a reference point that we're trying to compare price to see where other people might perceive value, that they'll take action of stopping their selling or starting to put in firmer bids. That's what we want. We want to be aware of it. So if it's simple or it's exponential, they're going to be within 10, 15 cents of each other anyways, and it's not a system.
Yeah, would you put more input on a VWAP rather than a moving average, since the VWAP is volume weighted?
On a very short-term period, I would. Yeah. So on a daily time, on like just one day.
Like a 2-minute chart, or a 5-minute chart, or even a 1-minute chart.
Yeah, I use it primarily on a 1-minute chart. I also, on my intraday time frames, the way that Realtic does it, I'll just show you, is that I can look at all these different time frames. So I've got a monthly, weekly, 2 different daily ones. That's actually 130 minutes. It says 120, 90, 30, and on my 90 I think is actually 60. So these are incorrectly labeled, but here's a 65-minute and then a 130-minute, which would be basically, still equal. 30, 10, or 15, 10, 5. So now I've got a volume weighted average price in here. I've got a 4-day volume weighted average price, 3, 2. So the way that Realtic calculates it, in other words, is from the beginning of whatever period I'm looking at. So if I have a 5-day chart, it's going to show 5 days, but it's actually going to be, on Monday morning at 10:30, it's going to show 4 days plus that next 10 minutes. Okay, so on the 1-day chart, it's it's only a 1-day volume weighted average price at 4 p.m. Over here it's a 1-hour volume weighted average price. But what I like to do is, for instance, this this stock here, it's a $4 stock. Okay, no, that's not the one. Wait a minute. I don't know why the date is off on here. Okay, so this stock broke out on, was that Wednesday, on earnings. And I look at it and say, since the earnings were reported, what's the average price? $4.20. Okay, so what's the significance of $4.20? That's the average price that is traded at over that many days. In Colorado, pot is basically legal. I don't know if you guys know that. Like, they have dispensary. 420 is like a pot culture thing too. I was wondering if anyone was going to snicker from that. But anyways, you get the, you look at the weekly time frame and say, does this stock have room to go? Maybe up towards $5 a share, but since the event is what I'm looking at. In other words, since this catalyst came, I want to know, what's the average? Why am all the dates are messed up on this. Let me see if that's on all these. And it is. But since that event occurred, the average price is at $4.20. So the buyers are maintaining control since that event. The average buyer is making money. The average short is losing money. So if you're trying to fade this event, so far you're not having any luck. And because it has this bigger bullish chart on the weekly time frame, then maybe there's some opportunity in there. A good example of resistance broken, was this stock. This was a great stock on Monday. This is CIGX. And you look at this, it consolidated. You could even, you see that 10-day moving average is above the 20 is above the 50, and they're all advancing. You look at it and go, wow, do you really trade $2 stocks? Yeah, they trade 1 million plus shares a day. Why not? It's, they're plenty liquid. We've got this resistance. You could even say, hey, that's a shoulder, that's a head, and that's a shoulder. But what's the point here? The point is the short-term, intermediate, longer-term trend have all kind of moved up, and the stock starts to show signs on a shorter-term time frame that it just kept hitting this $1.90 level. The more times this resistance was tested, and then we've seen it got tested here, the stock had a shakeout, the buyers came back in, took control, these higher highs and higher lows, it got back up, tested that $1.90, tested it again, and then buying right here was the great, for me, this was the trade of the week. I got in with a bunch of shares and got out of 90% of it that day, got out of the rest right here as it broke that little support, because the definition of trend on the short-term time frame no longer existed. So I got a bunch of it here, scaled out. I sold 10,000 of it up 8 cents. I sold some up in here and here, sold more in there, and then I got out the rest there, because now those higher highs and higher lows on this short-term time frame no longer existed. And that's when you get out, is when is the definition of trend no longer valid. So it pulled back, and you saw that this support right in here acted as resistance. And we had these higher lows, and we still had a rising 5-day moving average. Then on Friday, it re-broke out, and that, those are the types of trades that you're waiting for, whether it's a $1 stock, whether it's, a $50 stock. Those are the types of trades to look at.
Go back in once the...
No, I was out riding a bike in Central Park yesterday. Mosaic was a good trade on Thursday as it broke past 47.10, I think it was.
We took that trade.
You guys took that here too? Yeah, I was in that Mosaic, and you look at the daily time frame, it's it still needs work on the weekly time frame. It's still a hurting stock, but for a couple-day trade, yeah, that's a significant level. We got these higher lows. We've got all these tests of it. Those tests becoming more frequent. Then you drill down and you say, hey, the more times this resistance is tested, and then on Wednesday's close, we had this nice little bullish flag right there too, so that you didn't really even have to wait for it to break past the bigger level, which I think was 47.10. But you saw that there's that little flag that formed Wednesday afternoon right from the open, and then it was, that was the trade. Apple was a good trade above 260.40 this week. Past this level here, the Wednesday's high. It was basically in this little consolidation pattern here above those moving averages, and it had been holding the volume weighted average price since the earnings, since the event. So here I can go like this and say, since this earnings, here was the volume weighted average price. So we're holding basically above it. So I can take this pencil and draw there, and you see how the line is drawing up above. I'm not controlling where it goes. It's just automatically calculating. So since that event, that was the average price. And then when it took off, it goes quick, and the point is, why do we trade? So we don't have to live through this nonsense and sit there and go, wow, it's breaking down, now I'm losing money. I was up $5 in this stock, now I'm down $3, and you don't associate all those emotions that go with it. That's, trade, what people don't understand, a lot of people don't understand is, why do you trade? Isn't that risky? Not as risky as you're investing. Look at you. You're underwater. You haven't been making money for 10 years. What's risky about making money and controlling risk? And that's what trading allows us to do, is just control our risk. So the volume, I talk a lot about, okay, but only price pays. But it doesn't mean that volume's not important, because it does measure, it assigns how much emotional attachment there is to the market. You look at it and say, how much, how much trading took place, right? But it measures the emotion. When you see those big volume sell-offs, it says, wow, somebody's panicking here. And they say, people say, well, Vivus is down a bunch because the retail investors are bailing out of it. No way. I mean, it doesn't trade 20, 50 million shares a day, 500 shares at a time. Institutions panic as well. Otherwise, 95% of the fund managers would beat the S&P 500. But the fact is, 95% of fund managers fail to beat the S&P 500 year after year, because they're people. Just because they have more money doesn't mean they're any smarter than anyone in this room. They might have better information, but they still make the mistakes. Everyone makes mistakes. That's, making mistakes is a very large part of what I do. I make a ton of mistakes, but I recognize the mistake quickly, and I unemotionally say, well, the market didn't agree. Or am I sit here and fight it? With what? Or am I just keep throwing my whole account at it and fight it and tell the market it's stupid? No, I got to get the hell out of here. Women and children first? Behind me. I'm first. It's a selfish game we play. It's complete Darwinism, survival of the fittest. But it measures the greed, the participation, the greed and the fear. Volume tends to expand in the direction of trend. Okay, so a lot of times people say, well, I would have bought Mosaic on Monday morning, but I was waiting for the volume to come into it. Or I might have bought CIGX, but I was waiting for the volume to come in. If I'm looking at a stock like CIGX and I see $1.90, and I see it trading at $1.90, and the volume is pretty light for the day, and it trades at $1.91, I'm going to buy it. I'm not going to say I've got to wait for volume, because that's what the slow people do. Okay? Instead, I'm going to buy it, and when it goes to $1.98 and it's clear that the volume's coming into it, that's when I say I'm going to put 10,000 shares of this out. I don't care if it goes to 5. I'm reducing my risk. I'm taking some profit. And for those people that just chase the stock 8 cents in the course of 5 minutes, they're going to buy it from me because I anticipated they would be coming. But it tends to expand in the direction of the trend, and it'll peak at turning points. You can't use that as, hey, well, that's the biggest volume in 10 days, so that's the high, because tomorrow it might be even bigger volume or bigger volume. But the point is, once the news comes out and there's big volume, and someone on CNBC is saying about how great it is, then you want to start looking at that stock more carefully and saying, all right, I gotta, now everybody knows. It's still going higher. Now everybody knows, and I gotta, who's left to buy here in the short term? So I got to be real protective now. I got to go really into preservation mode. People say, oh, you know, this is something I've seen people say in interviews, and I think they just think it's, you know, a cool thing to say or something, that, oh, you know, how do you handle your winners? Oh, I don't handle my winners. They take care of themselves. It's the losers I'm worried about. That's complete bullshit. If you're not managing your winners, if you're not managing that Apple trade that you're up $5 in, a day and a half later you're down $3. How did that winner take care of itself? How did that CIGX trade work when it ran 15% in one day and 2 days later it's right back to where it started? The winners don't take care of themselves. You have to manage it. Just every single dollar you have in the market, whether it's money from your newspaper route or it's accumulated profits, even unrealized profits, it's still your money. Every dollar is equal to the first dollar you put in. You have to protect them all just the same. But it tends to peak at the turning points and diminish on the retracement. So as the stock rallies, it breaks out, the volume starts to expand, it starts to churn a little bit. Big volume without further upside tends to be distribution. Okay? Then it starts to drop. How's the volume on that drop? Well, if it's light volume relative to the advance, not relative to its average daily volume. Because what happens a lot of times is when you see a stock move from 10 to 15, then it pulls back to 12, it'll trade a peak of maybe 3 million shares. Then it goes from 12, or whatever the pullback was that I said, up to 18. And then it starts to pull back again. Well, the peak at 18 and the peak at 15, the first peak might have occurred on 2 million shares. The one at 18 million shares might have been, I'm sorry, $18 a share might have been 1.6 million. That's not as important because that first volume just kind of got people interested. It got all the sellers out. Now it's a trending stock. So just because it makes a higher high, and the volume peak this time isn't as big as the volume peak last time, that's not what you want to compare it to. In other words, the move from 12 to 18, you want to say, was the volume increasing on the way from 12 to 18? As it pulls back to 15 again, we want to see that volume diminishing relative to the way it was going up. And you know, if it fails to confirm and it starts coming down on heavier volume, then you know it does raise suspicion. And again, you know, don't wait for the volume. Okay, maybe if you're waiting for volume, say, well, okay, you know what, I'll do a starter position. I'll do half my normal size or a third of my normal size. I like to get involved. My preferred way of getting involved is seeing a stock like CIGX and having conviction that all the time frames are lined up and just going into it pretty heavy and quick all at once. And then I scale out of it. If I'm not sure about it, then I'll buy a little bit and then I'll wait maybe for the volume or something that the markets are going to do, and then I'll start to look at it. But this is the general volume pattern that you want to see in a bullish environment. It expands on the way up, and this peak might be bigger than this one. A lot of times this second one will be higher, but expands on the way up, and the volume on the pullback diminishes relative to the advancing. Not relative to the average volume of the 50 days or 20 days or whatever. And the biggest volume tends to occur near the turning point. But you might have said on this day, well, that's the heaviest volume, that's the turning point. So it's not good for timing, in other words. Instead, we want to blow this up, magnify it under a shorter term time frame. So if these were daily, we'd be looking at maybe a 10-minute time frame, 15, 5-minute. And we could see, here's a stage 1, 2, 3, 4, stage 1, stage 2. So if this is a big stage 2 on a daily time frame, we want to magnify that and say, okay, now it's consolidating in the stage 1 after that pullback. Now I want to start watching it for it to reemerge into that uptrend. The downtrend's just the opposite. We want to see that volume expands on these breaks, and then we get that low volume rally. What does that say? There's just not much conviction here. Warren Buffett's not in there with $1 billion saying, hey, this is a value. I'm going to buy as much as I can. Okay? Mike was showing those stocks, that got hit this week. We're talking about RIM and how when RIM gapped down, and it kept going. I mean, there's bad news. People are hitting the exits. It's time to go. But this is these are the types of stocks that you look at and say, now that's the type of stock. I want to monitor this and wait for the next break lower. I want to start to look at it on a shorter term time frame because it's bouncing and this prior support might act as resistance, so that would make sense. Look at the volume really diminishing. If I expand that on the shorter term time frame, how do I get my timing correct? So sometimes you do see the big volume though, like in a, like right now, earnings season. A big volume move will a lot of times lead to a sustained move higher or lower. Okay. It tends to peak at the short-term turning points, right? The biggest volumes. But that doesn't mean it's done going up. Same thing in a downtrend. Volume expands in the direction of the trend and then starts to trail off on these reaction, the corrections through price or through time. Biggest volume is typically when Maria Bartiromo was talking about how bad it is. That's probably going to be one of these days where it reverses. So I've spoken a little bit about moving averages. So what I'm trying to do here, the way that this, and I should have said this from the beginning, the way that this is structured, this PowerPoint that we're going through, is I'm trying to just take you through the fundamental concepts of technical analysis. Price, volume, moving averages, trends, support and resistance. And then we're going to look at time frames and how to combine those time frames to get our edge. That's where it's leading, in other words. So the moving averages, again, they're just a reference point. There's something to compare price to. It's a constant. Where is it relative to its average price over 10 days, 5 days, 20 days, 50 days?
You mentioned the 50 a lot. Do you view that sometimes as being a catalyst in a market? Because you said so many people look at it.
It's not necessarily a catalyst, but it's a, because you need a catalyst to move away from it, but it tends to be a magnet. It magnetizes price, and what's more important though is that it allows us to understand, why the 50, and I talk about the 50 not because I'm married to the 50, but just because most people look at that on a daily time frame.
Based on that you said most people look at. That's what
and therefore we can say more important than all this stuff about memorizing patterns, about memorizing resistance broken becomes support, memorizing why, which moving averages are most important, what's the psychology, what's occurring underneath. What typically occurs on a pullback to a 50-day moving average and on an uptrend is that it tends to find support in that area. But if you just go in and say, I'm going to buy it at the 50-day moving average, some days you're going to nail it, most days you're not, because it's going to need a day or so to settle in, and that tells us that the catalyst for us is, not the catalyst, but the what we want to do is we want to view it as a reason to dig deeper. Say, okay, on the 50-day moving average, it appears as though it's starting to find support. Why would that be? Well, that's where sellers typically stop selling, buyers start to come in, and it typically finds support. So let's look at the intraday time frame and see if there's actually evidence that we have a balancing out of the buy and sell. And it usually take a day or two for it to find that support in there to reach the equilibrium, and then when it breaks that higher, that short-term lower high or that little short-term resistance level, kind of like, well, let's just go back to this one just because it's fresh on my mind. If we have this CIGX, okay, right in here, well, this is that prior support. It was resistance, so now it becomes that focal point. So in other words, we're not going to buy at the 5-day moving average, okay, or the 50-day moving average. You could have made money by buying as soon as it touched right there, but you had to wait through a day of doing nothing. Then you had to get disappointed as it gapped up and then got crushed again. This is just, this sideways activity is just a waste of time. You could have made just as much money buying Apple on the earnings day that you did right here. But this is when it broke the resistance after these higher lows above a rising 5-day moving average. This is where you could define your risk. Where, buying it here on this day, as it's coming down, where's your risk? So it's about, using them again as a reference point. The 5-day moving average you could have made money there. I would much rather own it right here at $2.05 on Friday than I would have owned it at $1.95 on Wednesday.
In general, then, you prefer to pay for the breakout?
Yeah, almost always, because I have momentum. I have the buyers in control on this time frame, and on every time frame I look at, the buyers are in control here. Okay.
Has that general rule changed for you as the markets have changed?
Well, you know, when you're in a downtrending environment overall in the market, you know, right now here's what we're seeing right now. I think is that we're you know, the last couple weeks since the market reversed off that 102 lows, that there's been some great follow through, and as that follow through came, now we're starting to see something that's actually kind of more disturbing than anything, is that we're seeing a lot of these little names, these little stocks, breaking out and having big moves. And they're a lot of fun. You can make a ton of money off these little things, you know, especially when they're really liquid. Like this one trades an average of what is this? You know, it trades 1 million shares a day average. Or is that 10 million? No, that's 1 million. But anyways, you know, what's troubling, I suppose, is that, you know, that we're seeing a return of riskier activity, and it's good for follow through. But you know, when you have a longer term base like this is a beautiful. It's lined up on all these time frames. So I'm sorry, I'm not answering your question, which was. Does that change as the market environment changes? And yeah, because when you have the market, you know, back in February, March, in a real downtrend, well, less breakouts are going to hold true. That's, you know, when you have days where there's 2,000 declining stocks and 497 advancers, or 2,500 decliners and 400 advancers, breakouts just aren't going to hold as well. So what does work? Well, the short side works, but for me personally, I prefer the long side, because the short side, there's just all those little squeezy little bounces. It's more difficult, I believe. I've met a couple people who are good at shorting, and I don't consider myself bad at shorting, but I don't trust a short move as much as I do a long move. It's just, that's just me. Do you do a lot of short? I mean,
yeah,
I don't. Do you prefer, or?
Not really. I mean, I like the fast pace of the shorts. You definitely get paid faster.
Yeah.
But I like sitting. I do feel the same way. It's much more comfortable holding a long than holding a short.
But also for me, I prefer, if I'm going to get short exposure, I'd rather just do, you know, either the SDS or the you know, which is the double short SPY basically, or the what's the triple? What is it?
SPXU? Or no,
there's another one too, BGZ, I think. Yeah, BGZ is another triple short. So you can get some good action on that, but anyway, that's my because the individual stocks are really where it gets jumpy, kind of stupidly jumpy. Yeah.
Really quick, I was just wondering, your system or the way that you trade?
Approach is the approach. Yeah. Okay.
Is it more? Do you ever have difficulty with computerized trading? Or how does that factor in?
You mean like the high frequency trading and that sort of thing? Does that affect? It does. I mean, it affects the whole market. But I prefer to trade. So, for instance, I was bringing up Mosaic. Mosaic isn't my favorite type of stock to trade. New York Stock Exchange, very liquid, very, you know, algorithm oriented, I think. For me, the sweet spot, it's not the $2 stocks either. The sweet spot for me is probably 15 to 20 up to about $40 a share. Average daily volume between about 500,000 and maybe 2 million shares. That's just me, and I find in those types of stocks that they aren't as heavily oriented towards the programs, so they trade a little bit cleaner. Like that CIGX, I mean, it's a $2 stock, but there was no nonsense in that. It was just a nice, clean breakout that went. It had, you know, a slight pullback during the day, and I was telling G-Man this, that, you know, some people were saying, hey, that was a great trade on Apple, I made $5. I was like, yeah, that was okay. I mean, that's a nice 1.5% or whatever. But dude, what about CIGX on Monday? They didn't catch you at 15%? I mean, why is it more satisfying to make money, you know, points? So people are impressed with points. It's not about points. Just put more money into the low-priced one. If it's trading 1 million, 2 million shares a day, why not buy 50,000 shares? Okay, it's like buying 200 shares of Apple. Okay? You're going to make more money on the $2 stock with 50,000 shares if the liquidity's there, though. But how do you get out? Right. No, you can't, because, you know, I mean, not really. I mean, you could in some spots, but, you know, 50,000 shares of a stock that trades 1 million shares a day, yeah, you're going to move it maybe a little bit, but the idea is that you want to move it at the right time. If it is breaking out, and if you see that it's been trading 88, 89, and the speed of the tape is coming, you know, it's speeding up a little bit, and you see 20,000 shares offered at $1.90, you say, you know what, dumbass, I'll take those from you. And you take them, and you might clear the offer, and then somebody else comes behind you at 91, and then you're offering them out at 98, you know, a couple minutes later. So sometimes, you know, and it's fun. It's always fun in a bull market when you can move a stock. I like doing that. I like identifying that point. There's the point, and you can tell, you know, the higher lows have been coming. It just seems like the sellers are kind of like antsy a little bit. They're wondering if it's going to go or not, and you know there's a lot of people waiting with a volume alert or a price alert for it to get past whatever level. And if I look at it, I'll say, okay, let's just because it's fresh, not because but that $1.90 level, I might go, okay, well, I'd be comfortable taking 50,000 shares here. There's only 38,000 shares offered, so I'll go in with an order to buy 50,000 shares at $1.91. So by doing that, what I'll say is I'm willing to pay up to $1.91. I'm going to clear out the $1.90 so that all those dopes that were looking at that 38,000 shares as it was intimidating, like, well, I'll wait for it to get down to about 3,000 shares, then I'll take 1,000. Okay? Now they're like, oh shit, someone big just came in. You know, not that big. And then, oh no, now they're taking the 91s. And then the guys who are offering, they start to go, well, wait a minute, there's aggressive buyers in here. They're taking offers pretty quick. I'm going to cancel my offer. I'm going to go up to 97 cents, say 98, $2. And then more people start chasing it. So it's fun to be the guy that breaks it out. But you know, this isn't the market for it, unfortunately. It's not one of those just real nice bull markets where everything's breaking out.
I have a question. You say you prefer to buy stock rather than to short it. Do you kind of like, when it's not a market that's trending up, it's more of a neutral to bear market, do you kind of just sit tight on your hands and not, because I'm sure not a lot of the breakout plays work out.
You know, it's actually not true. I prefer just in general a neutral market. That might sound crazy, but I prefer a neutral market because in a rip-roaring bull market, I tend to be much too conservative. I don't want to chase stuff. I'll sell too early a lot of times. Those are my weaknesses. But in a neutral market, you've kind of got, you know, most stocks are generally healthy. Some stocks will break down, and you can short those ones, and they'll just kind of go. I mean, they go even more because there's not a lot of stocks declining. So when they start to break, more people jump on it short, and more long say, well, you know what, I'm done with that one. And so stocks are going to trade more on their own merits. They're not just influenced by an overall up or down trend. So you'll still see, like, a lot of the growth stocks will continue to break out and run, and you know, there's been some great trending stocks in this market. A few of them kind of, I wouldn't say blew up, but some of them got hit this week, like FNSR, APKT. Those have been really big trending stocks over the last, I don't know, even more than a year, I guess. You look at like APKT. it got hit on earnings Friday, and this was their last earnings report. But look at how long APKT's been on an uptrend. It's been a huge move. This stock hasn't seen any weakness. You look at FNSR, they reported on Friday as well. And here's a great looking base, and it's still a nice looking weekly chart, but the daily chart, looked like a good setup actually going into Friday, but it never broke past that high right in here. It started to show support at the 5-day moving average, and some people bought it at the 5-day moving average, and if they were smart, they sold it right on the open on Friday. But, that's just a reference point. We had the higher lows, and this is where it's correct to anticipate that it'll break out. But we want to wait for price before we participate. Crocs was a good one the last couple days. More than the last couple days, but I was looking at it since this little consolidation here. Crocs, nice little tight consolidation there at these highs, and great follow through with, we're in a stage 2 uptrend on the longer term time frame. But anyways, let me get back to this. I really don't know what time we're finishing, so I just wanted to speed it up a little so we can get to everything here. But they're a reference point. It just allows us to objectively say what's the trend. They do tend to act as support. Doesn't mean they will be, but they tend to act as support in an uptrend, tend to act as resistance in a downtrend. Crossovers represent indecision. That's generally after a trend, and that's stage 1 or stage 3. So where what's the direction of the moving averages? Where is the stock in relation to them? When looking at a daily time frame, where you kind of want to come up with your shopping list of ideas, I like to look at a 10, 20, and 50. I don't really look at the 5-day moving average on a daily time frame because it just follows too close, and you can't really see it. So early on, you tend to see support at the shorter term moving averages. As the trend becomes a little more mature, you get pullbacks to the deeper, deeper pullbacks. But then it doesn't mean it's topping out. With a rising 50-day moving average, I say innocent till proven guilty, and guilty till proven innocent with a declining 50-day moving average. But this stock finds resistance at the 10, then the 20, then the 50, then the 10, then the 20, then the 50. So here's just kind of an example of, would you buy this stock on this low volume pullback to the rising 10-day moving average? It looks like a good setup, okay? But you need to wait for price action to confirm it before you do, because here it pulls back. So, well, hey, maybe this is the support because there's the prior resistance, and there's a good a good pullback. Let's buy that. Not quite. So then it comes down to the 50-day moving average. And you can say, well, that prior resistance looks like support. It's been a nice pullback. That's probably the big volume at the end of this. That was the panicky sell-off. And not quite. So they're a reference point, but when they're in a short-term downtrend, you don't want to be buying those. You want to look at that short-term time frame and say, just because it's at this 50-day moving average means nothing. It's in that short-term downtrend still. It's still declining. The volume-weighted average price it's the purpose of the volume-weighted average price is when an institution wants to buy 1 million shares of XYZ, they say to the broker, get me 1 million shares today. And so the brokerage firm will say, okay, we guarantee VWAP pricing. What does that mean? So whatever the VWAP was, the volume-weighted average price for the day, if you take up all the shares traded at price and volume and average it out, the average price that stock traded at is 42. So get it to me at 42 bucks a share. And they say, okay, we'll guarantee you that. You're done on 1 million shares. So they have created these programs that say, 40% of or 30% of the volume becomes between 9:30 and 11 a.m. So they program their computer to buy 30% in those 3 hours, 2.5 hours. Then they say, well, during lunch, it does 10% of its average daily volume. So they they tweak it down. So that kind of reinforces that low volume middle of the day as well, because the computers are told not to trade during that time, because that's not when they're going to get their better pricing typically. So anyways, at the end of the day, you know, I want my stock at 42, and they say, listen, you know, consider yourself filled. We're doing it for you. We guarantee it. That's what we do. Well, if they're able to buy the stock at 41.85, that's their incentive, is to say, hey, we told them, we agreed. I took risk, but we agreed to this price. I sold him in advance, or, you know, I sold him in advance 1 million shares, but we used our own money, and this is where, you know, Goldman and those guys try to rip off other people to get the better average price. So if they can make it at 41.85, well, they've just netted 15 cents a share, and that's agreed to. That's not a commission. That's just, you know, they're just recognizing their end of it. They went short 1 million shares basically at whatever the VWAP is at the end of the day, and that's a moving target, obviously. So they want to try not to influence the pricing too much, and they want to. So that's what they do. If instead they buy it at 42.10, they don't go back to the customer and say, oops, sorry, we messed up, you actually own it at 42.10. They eat the 10 cents a share. So it's their incentive to you know, do these large algorithmic trades. And it can be used on any time frame. You can use it as a moving average, or kind of like I showed you how I was drawing that tool. But a lot of times it does act as a hidden support or resistance level, in particular early on in the day. And I'm going to show you one of my favorite ways to use it in the market. This was July 7th. I don't remember what the market did that day, but this is the SPY for that day, and we had a nice trend day. The market, you know, opened up, it pulled back to that VWAP and kind of consolidated in here. I love these little consolidations and then buying, you know, the next higher high in here. Early on, you'll see this a lot of times in the first half hour. It'll kind of dip below that VWAP, and then as it breaks out, set your stop underneath there. This was the day before. I believe the market might have gapped up that day, sold off. As it crosses back above the volume weighted average price, it says who's in control, the buyers or sellers. For this session, the sellers had control. We had a declining volume weighted average price. These are 1 minute, so for the first 30 minutes they took some profits. It kind of went sideways. The buyers were gaining control, and then it took off with a stop underneath that low of the day there, and then we have these higher highs and higher lows, but only for a period of time. I mean, this, you know, this is a beautiful move here from 103.40 to 104.30. Okay, now it was a horrible day for, you know, if you held it the rest of the day, but here we saw, you know, same thing, a little shakeout, and then it breaks that support in the morning lows, and then the sellers came in. I think I put yesterday's on here too. I wasn't trading yesterday, but it looked, you know, like a good one where, did it gap up yesterday? Or no, it gapped way down, that's right. So it gapped way down, and then what happened? Well, this is kind of just a blow up of that first hour and a half. The buyers regained control here, then that VWAP acted as support, and look at the volume in here too. We had, you know, volume increasing on these bars right here, low volume consolidation as it was right above that volume weighted average price. The volume came in again on this spike, then another lighter volume relative to these spikes. And so we had, you know, so that's also on individual stocks. And I know you guys do a lot of the news plays and that sort of thing, but when you see a stock gap up, it's fairly common, more so like this, is a stock will gap up that 2 or 3 points or whatever, and I know you're using ATR and some of those other things. It gaps way up, you know, and sometimes it'll keep, you know, it'll run for the first 10 minutes. The people who buy it there, in my mind, are just chasing it, and it's pretty risky. I prefer they kind of pull back down below volume weighted average price, then it starts to get back above it and set your stop underneath that low that it just made prior. That is really, in my opinion, one of the best ways to play gaps. And on the flip side, when it gaps down, rallies up a little bit, and then loops back down.
Do you feel like there's a natural tendency for stocks to like return to a VWAP after it's like oscillating?
A lot of times, like kind of middle of the day, you do see sort of a return to VWAP, yeah. But looking at it enough, when you have a trending stock, if the trend is higher, it's generally going to close above, you know, let's say we're talking about the SPY. 15, 20 cents above it. If you have a trending day lower, it'll close below it. So those people who are guaranteeing VWAP on those days, have the potential to get hurt pretty badly. But that's my favorite way to use the volume weighted average price. Here's another day. This is with July 1st. So here was the opposite. In a short instance, where who knows where it opened or closed the day before. But we kind of have this little consolidation. It looks like the buyers are taking control. Then the sellers came in, pushed it below that VWAP. The VWAP was declining, and then you just had a beautiful sell-off. It's just when it's trending, you look at it as for that day. These little rallies, you want to be looking at these little rallies in here as, okay, well, I don't have the volume here, but I would guarantee you that we could look at it and the volume was expanding here and lighter on these rallies. Because that's just the way the market moves. And then you see all these little pieces. Support becomes resistance here, right? Even on the 1 minute time frames, and kind of close there, but it stair steps lower. We have that surge, or in this case that drop, and then the correction. Here through price, here more through time. Okay? But we were talking about a 1 minute chart, you're talking about a daily, a weekly, whatever. But generally, my belief is you want to trade your day trades in the direction of the volume weighted average price. Sometimes it gets real far away from the VWAP, and it'll look like it's maybe finding support, and I find myself out of boredom going, well, I'll trade it, see if it mean reversion to VWAP. Well, it's so far down, I think I'll try it. And I end up usually probably 50-50 actually. But overall, I would say it's not a real favorable type of trade. But an uptrend, just like any moving average, an uptrending or downtrending will often act as support or resistance. You notice all these slides. It might sound like it's hedged. It is hedged because it's trading, but there are no certainties in the market. Don't ever listen to anyone that says the volume weighted average price is support. I saw some guy sent me a piece on the volume weighted average price just a couple weeks ago, and it sounded like it was written by someone in 8th grade. And he was saying the volume weighted average price is always support in the first 45 minutes. You can always make money when you buy it, when it touches it. I was like, who ever uses always in the market? There is no such thing as always. Anyways, but be aware of the direction of it, because if we're above a declining VWAP, okay, so just to bounce up through that, it will often fail. If we're below an advancing VWAP, that sell-off will usually fail, in other words, okay? And the steeper the angle of the VWAP, the greater likelihood a move above or below will fail, okay? So that's kind of your question, the mean reversion question. So anyways, the whole thing about moving average, again, I say this all the time, but it's not a system. Don't look at moving averages as a system, as these crossovers. I've been saying it forever that moving average crossovers represent indecision. And I love the fact, I really love the fact that this death cross that was so widely advertised just completely failed to do what people expected it to do. And the fact was that, the day that the S&P 500 got its death cross, it was already down 8 or 9% in the prior 10 days. It's not a timing system. It represents indecision on a weekly time frame. I mean, realistically, it really means nothing for what we're doing. It's just noise. It's like a PE ratio. Like someone saying, hey, well, the PE is 10, so now it's undervalued. What? No, it's valued properly, because that's what the market's paying for it. It's what are stocks worth? What's the bid? That's what it's worth. If you think the bid's wrong, try and offer it out. You might be waiting there for a while. Maybe the market will come get your offer. But stocks sell for what they're worth. It's not a system. Okay, it's just a way of looking at the market and saying it's a reference point. So if I was going to be forced to look at just one moving average to represent trend on different time frames, on a weekly time frame, the 40-week moving average, 40 weeks times 5 days is the 200-day moving average. Okay, you hear the 200-day moving average all the time. Just to say, what's the longer-term, direction of it more than anything? to say, who's in control, the buyers or sellers on, for the institutionally. On a daily time frame, a 50-day moving average. Why? Because that's what most people look at. On a on an intraday time frame, a 5-day moving average for those intermediate term trends of 2 to 8 days generally. What's the direction and where are we in relation to the 5-day moving average? And here is, if we had a 30-minute, if we had a 65-minute chart, we're looking at, like we do, or here we have a 30-minute chart, so we're looking at a 65-period moving average. These are all the same thing. 65 times 30 is equal to 195 times 10. Okay? So in other words, if we're looking at a 10-minute chart, a 195 period would be 10 or 5 days. 15-minute, 30-minute, etc. So that's how you do the conversion. I get all the time people say, hey Brian, you always talk about the 5-day moving average, and I put the 5-day moving average on my 10-minute chart, and it just follows real close. So that's because you put a 5-period moving average. You're taking the average of the last 5, 10-minute, it's a 50-minute moving average you're looking at. You're not looking at a daily. If you want a 5-day, you look at 195 of those minutes. That's how you get it to line up. And on a daily time frame of 1 day, it's the volume weighted average price. So this is where we kind of tie it together. Okay? And how did I get from Denver to SMB? Would I start with a map of SMB and say, okay, that's where I need to go? Okay, it sounds foolish, but or do you look at the big picture first to say, hey, how do I get into that one little spot? How do I make 40 cents on MOS? How do I make $5 an apple? Do I just look at the intraday chart? No, you have to kind of frame it and say, where is the bigger picture? What makes the most sense? You have to understand that structure and how the time frames flow together. Like, if you're driving cross country, and you're looking to get to your aunt's house or whatever, you don't just start, if you're starting from here and you're going to Kansas, you don't start with her street, you don't start with her town or county or the state. You look at it and say, okay, we got to take 70 west until we get to Kansas, then we go east on or north on whatever, and then you drill down in your map or on MapQuest, and you take a closer and closer look. It's the same thing with the stocks. You can't start with your destination. You start with the bigger picture and try to make it so we want that trend alignment. We want to get the bigger reference first. So when it comes to trend alignment, it's really based on Dow theory. And Dow theory is there's 3 types of trends in the market. You've got the major, the secondary, and the short term. This is the way Charles Dow defined those. Okay, many years, 2 weeks to 3 months, short-term trades, insignificant ripples that last less than 2 weeks. To me, that's, I would define that as kind of intermediate term. That would be long term. So anyways, the way we want to use it though is you want to combine the time frames. You want to look at whether you're an investor or swing trader, day trader, you always start with a bigger picture first to just kind of get your feeling of where are we in the overall picture. Just kind of your shopping list. The intermediate term says where are the major support and resistance levels that have been significant. That gives us the basis of our risk reward. Okay? Where has it been? Where does it have the potential to go to? And the short-term time frame allows us to fine-tune. If you were an investor, you'd start with a weekly or monthly time frame to get that 10-year view. Then you would go to a daily chart that goes back maybe a year as your intermediate term, saying here's the support and resistance. And a short term for an investor might be 65 or 30 minutes. Some investors never ever look at the intraday time frame. You look at these charts sometimes and say, who the hell would be buying here? Man, it just had this huge move of 50 cents in the last hour. And they're looking at 50 cents. We're in this thing for $50. We think it's going to move in 2 years. We don't care about 50 cents. So they're not trying to be as precise as us. They're just trying to get it. If you're a swing trader, you'd start mainly with the daily chart. You might want to look at a weekly chart just for reference if there's something on that daily. Let's say it's breaking out to a new high on the daily time frame. You'd back it up to a weekly time frame to say, well, is there a big potential resistance level right nearby maybe, like that SATC that I just showed you. You know, you had to go back to 2002, 2003 to see where's the next potential target. Intermediate term would be, you know, 65, 30, or 50 minute. And then to enter for a swing trader, you'd enter using a 10 minute, 5 minute, 15 minute. And for a day trade, your daily chart or your primary trend, probably daily I would say as well, but you know, 65, 30 minute, just to get that kind of, you know, see where those intermediate term cycles are. And then the next one would be a 10, 15, or 5, and then really for entering the trade, that's where you're sitting down going, okay, here's the precise level on the last 1 or 2 days. This is where I want to get involved. This is how I can really manage my risk and you know, get your stops to 10, 15 cents in some cases. And I'm talking about $30 stocks even, but you know, you want to manage your risk on the shorter term time frame and use that for your entry. So what's the current trend? This is for swing trade, okay? You want to say, what's the current trend? Well, you look at the daily time frame. Generally speaking, if the 50-day moving average is advancing, it's innocent till proven guilty. If the 50-day moving average is declining, guilty till proven innocent. Where's the support and resistance? That's, again, where does it come from? Where does it have the potential to go? Is there enough perceived reward relative to the perceived risk? And that's, you know, is there a profit zone? Which is basically the same thing. So we've already said this, but again, where does it come from? Where does it have the potential to go? Or what you want to ask yourself. So when it comes to actually finding a trade to take, you know, and this is for a swing trade, okay, you would say, let's start out with that daily time frame. That's our buy candidate. On a long, we only want to consider stocks that are in an uptrend on their daily time frame. Now, when we're looking at the secondary trend, which would be, you know, we'd be using the 5-day moving average as well in here. We'd say, well, if it's in stage 1 accumulation, then the bigger picture is in an uptrend. So picture that it's in this uptrend, higher highs and higher lows. Now it's pulled back and it's kind of gone sideways. So that's where we want to anticipate and plan this trade out and watch it, stock it. When it starts to move back up out of that little pullback and makes it a little higher low, that's where we want to participate. As it rallies up and starts to turn sideways and maybe the moving averages cross, we'll get our first lower high. That's when we want to exit. And if it's in a downtrend on the short-term time frame, but in an uptrend on the daily time frame, you can make money shorting it, but that's not the odds. Generally, you just want to avoid it and use that. You know, so you use the 10-minute, the 5-minute, the 2 and 1 minute to really determine when to get involved. So here's how that would work. I kind of showed it to you with the CIGX, but you look at this and say, hey, we've got a rising 10, 20, and 50-day moving average. Here's a potential buy candidate. Then you would look down at, here's a 10-minute time frame. And I don't have the 5-day moving average on there. I don't know why, but you know, when we have this indecision, it's kind of going sideways. We want to buy a higher high, set our stop underneath these higher lows. As it turns sideways, we get the lower high. We want to either sell in that indecision or as it breaks down. We want to avoid this stage 4 decline, and then we want to start to look for signs that it's accumulating again. And when it breaks that higher high and we have these higher lows, here's where we participate again. So when you look at them side by side, that green boxed in area is blown up on the right. So that's kind of the idea of trend alignment. Okay, we saw it with CIGX, Apple, Mosaic as well. Because I don't have a lot of slides on here for that, but I like using real examples. So when it comes to selling short, again, as G-Man says, he loves taking advantage of that quick. I mean, because they generally do decline faster because there's more emotion with it because it hurts twice as much as, you know, the corresponding pleasure. So there's tremendous profit opportunity. Buy stops, you know, generally again just an idea, not that you want to put them in because you're going to get screwed most of the times with stops. But if you're not disciplined enough to take the action, what happens a lot of times is we'll say, I'll short it at 40, and if it goes to $40.30, that's my stop. Well, it goes to 40.30, And, well, I was at the bathroom, and now it's 40.35. I already went through that. It looks like there's a bigger resistance level at 40.50. So I'll add a little bit to it, and I'll probably, it's going to fail. And they keep re-justifying it. So if you have that discipline problem, then set the stop. But otherwise, I think you're better off manually executing the order than leaving it up to a specialist to take care of you, or just the computer to do it. Anyways, some of the biggest rallies do occur in downtrends. They're okay to trade. I mean, in the SPY and that, we some fantastic trading opportunities. Generally, when it comes to individual stocks, though, I don't break that rule. I don't think, well, I'll try and catch an intermediate term trade. I'd rather just go in SSO, BGU, whatever, and get long exposure to the market, because you're diversified. So, the risk of a down 20% move on a gap in the S&P, I mean, that doesn't happen. It happens in stocks, though, and news and surprises tend to follow the direction of that trend. So to get rid of that company-specific news, I think the ETFs are better for shorting, and in particular the inverse. But that's me. It's a bonus if there's bad fundamentals, but a lot of times, once the bad news is out, it's already too late. The stock's already bottomed out. The shorts have covered, and value guys are moving in. And you don't sell short stocks that are up too much. I mean, that happens all the time. There's always the stocks that just crush the shorts over and over and over again. Apple, Green Mountain Coffee Roasters, Crocs a couple years ago, everyone was trying to short that on the way up. Taser was one of the best short squeeze stocks ever. But there's no such thing as up too much. Compared to what? Not compared to what the next guy might pay for it. Or the PE. Anyways, and always consider covering some when the so-called bad news is out. For short sales, it's just the opposite. We want to start out with our primary trend. We want a downtrending stock. Then we're going to say, on our intermediate term trend, if it's in accumulation, meaning it's just dropped and it's starting to turn sideways, well, we want to be out of it. If it starts turning back up, then we want to avoid it. But where we really want to get interested is if it drops, it rallies up on light volume and starts to turn sideways. That's that little stage 3 distribution on the short intermediate term time frame. That's where we plan our trade. When it's down, when it's now below the declining 5-day moving average and it cracks a lower low, that's when we participate. And a stock that broke down nicely recently, I think this was this PD? No, it was a good one this past week with PDCO. But anyways, here's one where it's clearly in a stage 4 downtrend on the daily. Then you look at the intraday 10-minute time frame, and you can see here's that 5-day moving average. Kind of went back and forth. I already had the lower highs and lower lows. I prefer to get involved when it breaks this bigger, stage 3 level. You could short. Now, here's a stock that was showing it was weakening as it opened on strength these 3 days and then dropped off towards the end of the day. But these are the best places to get involved in these stocks, is when the momentum comes back into them. And here they are, kind of side by side. So this was 30.41. So I guess this is right up in here, maybe this day. And then we had that subsequent drop. Okay, well, I guess I made it through the whole thing. But anyways, questions, and we've got some stocks here we can look at as well. But
I have one, Brian. In terms of execution, because it seems like you are getting into the break. What's your style in terms of sizing versus the real stop for some of those positions? So on some of those you might have to risk 60 cents as the real stop. Will you go all in, and then if it doesn't start going your way right away, then you just get down to the amount of size that you really are willing to risk with the appropriate stop? Or
I do. I prefer to get in when I think it's the time. Mm-hmm. So for CIGX it worked perfect. It just kept going. But if I had a full position size on and it just stalls there, mm-hmm. and more size comes in, and I'm looking at the bids going, I don't know. I might even sell if I bought the 190s, mm-hmm. and I might start getting not necessarily nervous, but just concerned that maybe it's not as good as I thought. Mm-hmm. I might say, you know what, I'm going to hit that bid for 20,000 of it or I probably wouldn't do 20,000, but I'd say I'm going to sell 10 of them here at $1.89 just in case, because I don't want to get stuck with a full position. And then I'll look below and I'll say, well, let's see how it takes this 10,000. And maybe I'll buy them back at 191 or 192, but I'll just test it and see, wow, shit, did I only got filled on 4,800, and now that's the offer for 652, and I got another 35 behind it. Uh-oh, I'm screwed here. So I'll look at it and I'll say, well, it looks down to 185, and then I'll just put my whole order out and just say, screw it. I'm not going to mess around with this little penny stock here, because by the time somebody else, I don't like to delay on that. I'd rather be the guy who ruins it for everyone else, who's kind of waiting and saying, well, let's see what happens. Let's see if any real sellers come in. I'd rather be the guy who just says, sorry guys, you got trapped and I'm out first. Again, kids and women to the back, me first. Yeah.
On your blog, I see often you use VWAP as in like event, since a certain event, like since an event high or like back in 09 since the March lows.
Yeah.
Like how far back do you feel like using event-based VWAP becomes sort of irrelevant to the current?
Yeah, that's a good question. I honestly, I'm not even sure, to tell you the truth. I think that, you look at since the highs of this year, there's the volume weighted average price. So it was kind of looking encouraging, I guess, and that's still a battle being fought. So the average price since the high, another one that was interesting is that, since the March lows, that's dead on, and it also fit with the 38.2% retracement of the 07 high to the lows of 08. So that makes that an important level. It was the 38.2% of that, but it was also, what I meant to do was actually, did I do that right? The 38.2% retracement of, and this looks confusing because I have this extra line, ignore this one, but from here to there, that's 38.2% of that move. And it was also the volume weighted average price since that event. It tends to be like, so for instance, you have the Fed will come out and we'll get some real big volatility. When was the last Fed meeting? Was it, I know it was a couple weeks ago. So a lot of times after the Fed, you'll see that the VWAP since the Fed kind of is good for about 4 or 5 days. On an earnings report, where a stock gaps up or down, you'll say, what's the average price since the event that motivated a lot of people? Because earnings are the biggest catalyst there is. The whole idea of stocks is to be a partner in a company, and you want to be a partner in a company that's making money and not one that's losing money. So it's that catalyst that drives a lot of decisions. Every 3 months we get a report card. You're either going to be punished or you're going to get rewarded. Here's your allowance, or you know what, you don't get to drive until your next one. Stuff like that. It's kind of the same thing in the market. So since that event, since an FDA report, what's the average price been? So how long back? It's tough to say. I don't know yet. I don't know. It's still, the whole VWAP stuff, I was looking at some stuff. I've been looking at it since 2002, but it seems to be getting more and more popular, and more people are kind of, I only started using it since the event probably 2 or 3 years ago. I started figuring that one out, and I really don't know. But I like to look also at, well, since this trend began, let's say, since, from this low here, this most recent rally, what's the volume weighted average price been? So you can see that, it actually acted as support right there on that day. And then we had a brief shakeout, but it's still acting as support. So since this most recent move, the average, from this low, from the July 20th, since that event, the average long is making money. But we're now, right here, kind of at this crossroads. Okay? It's the market really impressive the way it held up on Friday, I think. But now we're right up to that 5-day moving average, which is just starting to flatten out, decline a little bit. And I mean, almost perfect that this support in here acted as resistance, and then we hit it again on Friday. So it looks like we're kind of distributing and maybe getting ready for a leg lower on this time frame. But if we get back up above here, and then that level in particular, you look at the 30-minute time frame, you'd think we're in a bull market, right? Higher highs and higher lows. The big pullbacks are occurring at a higher level. We have 2 higher lows. We have 2 higher highs as well. But you back it up to a daily time frame, it's a big mess. You back it up to a weekly time frame, and we're in a downtrend. I mean, it's lower highs and lower lows. So we don't have this nice picture-perfect trend alignment that I'm talking about. But you can still find it in some individual stocks. You look at stocks like this one, Autodesk. It's consolidating under here. It's got this little, nice little consolidation. These higher lows just recently. You look at AIG, could be maybe getting ready for another nutty type of move. For the first time since this, we now have the rising 10 above the rising 20 above the rising 50-day moving average. It's kind of broken this little resistance. It's holding up in here. And AIG is the type of stock that you get this thing back up through 40, it could be another period where it goes 5 to 10 points a day. So these are just some of the stocks that I'm looking at that up on big volume here, lighter volume consolidation of the rising 10-day moving average. So you start with this daily time frame, say, looks pretty good, rising 10, 20, and 50-day moving average. Where does it have the potential to go? Well, we have to look further to the left, so we want to look at the weekly time frame. And where are we right now? We're basically right here. If it gets up through this level, could it get to the mid-30s maybe? CHK is looking like it's on the edge of a cliff. But it's looked like it's been on the edge of a cliff for a while. But look at this little bearish flag on the weekly time frame. When is it going to finally break these lows right here? Below 2075 or so, maybe that's going to get this thing going. But it's just too damn choppy. Look, this is a mess. This would drive me nuts. So this is the type of stock that I don't trade most likely, and then one of these days, Tuesday, Wednesday, Thursday of next week, I'm going to go, I knew it, and it's going to gap down 5 points. So maybe the answer there, or the better answer, is you buy puts on something like that. And you say, you know what, I've seen this enough times that I know I would get chopped up in this, or I would just get tired of this nonsense. I get stopped out for a loss, and then it goes. So sometimes options are a good way. Focus Media is right up here again, and what's the average daily volume? Well, I guess I don't have it here. Here's a stock, 800,000 shares a day, 900. That's a nice looking weekly chart. If it can break this range, you got 23, 25 bucks a share. So you look at this too, and here's another thing is to say, well, price has memory. What is the memory of people from this period over here? Well, we could say, well, from when it broke this support right here, the volume weighted average price in there was right at about 28 bucks a share. Okay, so maybe that's where it's going. So that's another way to use it, just to kind of estimate. Another way I'll use volume weighted average price since an event is with short interest. So you can look at short interest and say, if you go to like NASDAQ.com, they give you the last, I think, 12 weeks or something. Hold on. So you could look at this and say, for instance, FMCN. All right. You look at this and say, okay, well, it has a short interest of 9.8 million shares. Average daily volume is 829,000 shares. So if they were the only buyers in the market, the days to cover or the short interest ratio, oh, that's not even showing it, I'm sorry. The average daily volume is 829,000. It would take them basically 12 days of just them buying to get flat this stock. Well, that's interesting, but what's the trend of the short? Actually, the trend of the short is they've been covering since August at least. 21 million shares was the highest. They added a little between December 30th and January 15th, but what I like to see is that if we had, for instance, 2 million, 3, 4, 5, 6, 7, 8, and you could say, okay, well, the average short is involved at approximately $16.80, and here we are at 18.10. How would you feel if you were them, or in being short, if and when this stock breaks out? But we've got this stock now above a rising 10, 20. The 10 and 20 are above the rising 50. We're getting volume on Friday, which was a down day for the market. The stock was strong. This little resistance acted as support. You look at the 10-minute time frame, it's holding up nicely in here. So these are the types of stocks that get my interest. Nice tight consolidation up here. And if it breaks out on the weekly, you got some room to run. INFA, this is probably, and I don't know, but I would bet it's an earnings report that got it in motion here. So since that earnings report, what's the average price? Right up there, and we touched it that day, so it's right in here. Now, it doesn't mean I would be discouraged, but it would tell me, okay, well, what else do we have here? Maybe it's going to take a move above this level right here. This would be what my my trigger point would probably be right here for a half position, then maybe add to it as it breaks out to new highs. But we saw Friday, we had a shakeout, then we had a higher low here. Now if we can match that with a higher high above this line at about 30.5, then maybe INFA is going to get moving higher, and that's the volume weighted average price of last week, so this is the last 5 days. So maybe above 30.50, this thing could go. We have this low, and we have a higher low, so maybe a stop near 29.80. So would you risk 80 cents for the potential to get involved in this trend that maybe it's headed up towards 32? And that's where it comes down to what are you interested in? ISLN had a nice breakout on real big volume, relative to its average daily volume. So here's the event. Relative to that, the volume diminished. You look at a weekly time frame, it's still got some room probably right up to here. I mean, this is not necessarily that this support, which became resistance, is going to be again, but that's $19 a share, and there's probably enough people looking at charts drawing that same line saying, hey, it looks like it's got 19 in it. So looking at a 10-minute time frame, just a real nice tight consolidation up here. We had this rally, it went sideways, we had slight lower highs and lower lows, but really didn't go deep at all. Now we've got these higher lows, and where's the trigger here? Is it above 18 maybe? But those are the types of setups. Even a small one like MPG. This one looks like CIGX did before it went. It's got this nice tight consolidation here, kind of building this little launching pad above all those moving averages. Trades 1 million shares a day.
Still like a 400,000 offer slowing it down 13 cents.
What's that? Oh, you've been watching this one?
I paid the other day for 20 of them and to see if I could get the party started.
MPG? Oh, did you try to push it? So, yeah, I mean, there's a lot of guys that like to try to push the stock. That's your advertising. So, yeah, it looks like it should have gone right there. I would have been excited. I would have been excited Friday right there at that point. But I guess, and this was G-Man's print. But yeah, I mean, look at this chart. I mean, it's just, but this stock is, I figured you might like, because this one had a massive, it was just a beautiful trading stock earlier this year. And now it looks ready to go again. So does, Vonage. Vonage is poking up right here at this 249, 250 level. And Vonage still, I mean, you look at the weekly chart, it's got some room to run to at least 3. I mean, 50 cents, that's 20%. And here you can see the So that's what using multiple time frames is. And here you can say, well, is that a cup and handle over the last 15 days? Sure, why not? Or wait, nope, it's an inverted head and shoulder, right? Well, who cares what you call it? This is pretty important though, right up in here. The neckline or the cup line, whatever you want to call it. Here's the level. We have these lows, and we have this higher low. And not that I would buy it at 250 and set a stop at 225. That seems foolish. Okay. Instead, I would say, where can my stop go? Would it go at 225? Would it go at 234? Okay. That's where it comes down to, well, if I want to buy 50,000 shares, my stop would probably be right here. If I want to buy 10,000 shares, maybe down here. You know. So it depends on, if I think I'm going to get most of the move today, maybe I go 80,000 shares. Maybe I try to push it. Who knows? But I'm not going to get up to go to the bathroom. But there's a lot of good-looking stocks still out there. This SWSI broke some resistance with some volume. Anyways, I don't mean to keep talking and talking. If you guys got questions, or you want to look at a stock here, let me know. But there's still a lot of good-looking setups out there.
What do you think about SIRI?
I think it's a penny stock that, bulletin board. I don't like it because it has all these decimal spots. I'll trade low price ones, but with 4 decimal points, I don't trust them. But Sirius, it looks like it's trying to kind of consolidate in here and recover. Probably needs to clear $110 really to get going. I don't like Sirius because it's too liquid. Trades, what is it, 63 million shares a day. To me, if I'm going to buy 50,000 shares, I want to see it go. I want to see me clear the offer. I don't want to sit there and go 10 million shares, 20 million shares. It's still trading $1.03. So for me, it's just it's like trading, it's like the Cisco of penny stocks. Cisco never, takes 10 million shares to move it a penny. Anyway. Any questions about concepts rather than an individual stock, or we good?
Yeah, I have a question about the concept. When we're talking about psychology of the market, do you break it down into like sectors of people? Do you say, all right, and the retail investors are going to be looking at these indicators, and the institutions are going to be watching this 50-day moving average, and you try and, how granular do you get when you're trying to think about the psychology? Do you kind of do the Wyckoff one great actor thing?
I haven't read that, but I like the one great actor. I just kind of view it as 3 camps. Either long, you're short, or you're in cash.
Okay.
How does the institute, because we're all people, and again, the institutions, they just have more zeros in their accounts. They're not really smarter than us. I mean, some of them are. There's some true stars, but there's true stars trading $20,000 accounts. They can get it up to 200 by the end of the year and then drain it, for their income. But yeah, just long, short, and cash. How would I feel? How would the average participant feel?
Okay.
Anything else? All right. Well, I know it went on for a while there, but hope it was good.
Yeah, it's great.
Cool. Thank you.
We're getting overtime today?